The unit price of equity linked savings scheme, okay, ELSS of a mutual fund is rupees 10. Okay, so this is NAV. The public offer price of the unit is rupees 10.204 and the redemption price is rupees 9.8. We need to find out front end load and back end load. Okay. Usually what happens in a mutual fund scheme is that there is something called front end load and also there is something called back end load. So suppose you are investing rupees 1000 in a mutual fund scheme, in a MF scheme. So if there is entry load or front end load, then not this entire 1000 will be invested in that particular mutual fund scheme. Okay. There is something called entry load or front end load, which is deducted from this scheme and only the balance is put into this mutual fund scheme. Okay. Suppose we say that entry load is 2%. That means if I invest rupees 1000, then out of this 2%, that is 2% of 1000 is rupees 20, is towards load and remaining 980 is put towards investment. Okay. So this is front end load. And similarly, when we come to back end load, that means my current value of investment is rupees 1000 and I want to withdraw or redeem. Okay, full amount. Then in this case, if there is no back end load, then you can get the entire 1000. But if there is back end load or exit load, let us say of some 2%, that means out of this 1000, 2% that is rupees 20 will be charged towards load and you will get only 980 rupees to your bank account. So this is what investor gets. Okay. So this is back end load. So load is something which is charged to the investor during entry and exit into the mutual fund scheme. Entry into and exit from the mutual fund scheme. If it is during entry, it is called front end load. If it is during exit, it is called back end load. So now coming back to the question, what is given? It is given that the NAV is rupees 10, but POP is rupees 10.204 and redemption price is rupees 9.8. This means that if an investor invests 10.204, of which this will go towards investment rupees 10 because that is the NAV and remaining 0.204 is towards load. Okay, this is entry load. Similarly, if investor redeems rupees 10 from the investment, then rupees 9.8 goes towards goes to his bank account and balance rupees zero point 0.2 is deducted towards exit load or back end load. Okay, so this we have derived, right? Now we want to find out the exit load and entry load in percentage terms. That means entry load percent is entry load by POP, right? So it is 0.204, that is charged out of how much? That is purchase offer price, right? You'll take this and you'll not take this. So it is by rupees 10.204. That is 0.204 by 10.204. That is 1.999. So it is approximately 2%, right? Similarly, exit load percent is nothing but rupees 0.2. This is the exit load divided by this is charge, right? So on how much? It is 10 rupees 10. So 0.2 by 10 is 2%. So entry load is 2% and exit load is 2%. So this is how we find out entry load and exit load, which are nothing but front end load and back end load. So this is front end load. This is back end load, right? So problem number 2, given that purchase offer price is rupees 10.204. Okay, this is nothing but POP. Okay, next, net asset value per unit, that is NAV, is rupees 10 and redemption price is rupees 9.8. Okay, front end load is nothing but 10.204 minus 10, that is POP minus NAV, and divided by on what? It is POP, right? And back end load is nothing but NAV minus redemption price divided by NAV, right? Because we have seen, right, rupees 10 minus rupees 9.8 divided by 10. So rupees 10.204 minus rupees 10 by rupees 10.204, and here it is rupees 10 minus rupees 9.8 by rupees 10. It is 0.204 by 10.204, that is 2%. Here also it is 2%. So this is the solution, right? So what is the formula that we have to use? Front end load is purchase offer price minus net asset value divided by purchase offer price, right? 10.204 minus 10 divided by 10.204. Now back end load, that is net asset value minus redemption price by net asset value, right? So these are the two formulas that we need to keep in mind while solving this problem.